A boon for bonds. Fixed income set to see an additional boost as the Fed is expected to raise interest rates and is unlikely to change its course until inflation data improves. But not all fixed income is made equal. Here with more is Chip Huey, Truist Wealth Managing Director of Fixed Income. Good to see you, Huey. So as we've been mentioning there in the intro there, lots of different strategies. You have obviously active, passive, a hybrid. For people who are trying to figure out which strategy or how they should use these strategies in this environment, how should they navigate this?
Yeah, great. Thanks, Rochelle. It's great to be with you. Thanks for the opportunity. I think that there's really two main ways where we see an attractive opportunity in fixed income, two ways to approach it. So on the one hand, we have sort of the passive approach. In the front end of the yield curve, in the first 2-3 years of the curve, we're seeing some of the highest yields that we've seen in the past 15 years. And that's largely a result of the Fed's interest rate increases. And so buying individual high quality securities there, you're capturing some of the highest yields we've seen in more than a decade, but it also gives the opportunity to allow those bonds to roll to maturity and to make routine reinvestment decisions at that point. Given the economic uncertainty we've seen, that's a pretty valuable amount of optionality, flexibility in making new decisions as we get new data.
So then what are some of the ones that you're rolling out or rolling into to really account for some of the changes expected ahead?
Yeah, so that speaks sort of to the other way to approach it, more of a portfolio or total return context. Back in late October, we upgraded our views of durations, or so longer dated fixed income, because we do see risks of recession rising as we progress through this year. And if you go back through history, long duration or longer dated high quality fixed income does tend to outperform as the economy slows down or enters recession. So from a portfolio context, we saw greater value in duration as the 10-year rose above, call it 4%, 4.25%. And that's still what we see. We recommend a few things. One, keeping fixed income simple for right now, staying high quality in anticipation of opportunities in riskier fixed income down the road over the course of the next 6 to 12 months. That will probably be a better opportunity for an entry point at that point. Right now, though, when we made that upgrade to duration, the 10-year was a fair amount higher, about 4.25. So we would be a little bit more patient for major duration moves right now. We are right in the middle of the trading range that we identified coming into this year. But if we see yields rise up towards that 4% range again, value comes back again for duration.
Now, this can be hard because obviously a lot of people, when we see the markets move with every single Fed announcement, we know that the Fed is going to continue on this road. At least we're expecting that 25 basis point hike, but still don't seem to be at that threshold where they plan on pausing anytime soon. How are you factoring in when then to extend or reduce duration on some of these?
Yeah, so we do expect the Fed to raise by 25 basis points next week, possibly 1 to 2 more 25 basis point rate hikes beyond that. And then we expect the Fed to move to a pause and to hold rates steady. And I think that one thing that perhaps the market is underappreciating, we think that it's a really high bar for the Fed to start reducing those rates. They have a tremendous amount of scar tissue from the inflation experience that we've just gone through over the course of the past 12 to 18 months. And we're going to need to see inflation data consistently cool and stay on this downward trajectory before the Fed gains comfort in potentially cutting. And right now, the market is pricing in multiple cuts by the end of this year. We're not completely convinced that the Fed won't hold steady and allow inflation to cool, and also to relieve some of the tightness that we're seeing in the labor market.
I mean, between some of the extra optimism, as you were saying, in some of these estimates as to when the Fed will start cutting this year, you also have, of course, issues over the debt ceiling. Now, obviously, we're expecting this to be resolved, but what should people keep in mind as we have this period of volatility right now?
Right. I'll say right out in the outset, because we've been getting a lot of questions about this, and it's a really important question. We do think that ultimately Congress comes to an agreement and the U.S. averts default. But if we go back to the most similar proxy to what we're seeing now, we have to go back to 2011, when it was another contentious debt ceiling debate. And what we did see is, as that deadline approached, investors grew very uneasy. Actually, over the course of about a month, the 10-year fell about 100 basis points or 1% in yields as investors flew into quality, right, into a risk-off mentality. And we saw rate volatility really spike around that deadline. So we do think that it is likely that we will see volatility increase as we move towards that deadline. The likelihood of some kind of brinksmanship tactics and some 11th hour negotiations could make the market feel pretty uneasy. And so that is a deadline to watch, but we do think that the worst outcomes that a lot of attention is on right now are ultimately going to be avoided.
Well, certainly good to keep that in mind, because when things start going a bit left towards that, people should keep that steady hand that ultimately Congress does always end up resolving this. Chip Huey there, Truist Wealth Managing Director, Fixed Income. Thank you so much.